Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, navigating the IRA contribution rules for 2023. And the good news is there is still lots of time to make IRA contributions for 2024. So watching this video is imperative because you're going to learn, number one, different types of IRAs, the benefits, the rules, and how the contribution deadline rules work. Because whether you have an IRA, a Roth IRA, a SEP, or a simple, there are different deadlines for making contributions. And why understanding the contribution deadline rules are so important is because the retirement system is based off the principles of compounded returns, deferrals. The more money you put in, the earlier you start, and the longer you have those funds in the retirement account, generating gains, the more money you will have when you retire. That's simple mathematics. It's based off the powers of deferral, compounded returns. And that's why making IRA contributions every year is so important. Even if you just put in a little bit and things are tougher this year, maybe than last year or the year before, and that's fine. Maybe last year you put in $3,000 or $4,000 in your IRA, and this year you can only put $500 in. That's all right. You want to maintain good habits. Every dollar matters. Why? Because it grows. Rule of 72. You average an 8% rate of return, your money will double every 9 years. Okay, so if you average 9%, 8 years. So it just takes patience, good habits, making contributions each year, and understanding how the rules work. And that is the whole purpose of today's video. So obviously you guys know who I am. I'm Adam. I've written 8 books on self-directed retirement accounts. I'm a tax lawyer, I have a master's in taxation. I've worked at some of the largest law firms in the country, and I know this stuff pretty much better than anyone in the country. So hopefully you guys are going to enjoy the video. I'm going to keep it shorter than usual. A lot of my lives go for like an hour, but this is kind of meaty. This is about rules. So I want to keep this short to the point so everyone gets the data and information they need and can move on. So we're going to start with the traditional IRA. We're going to move to the Roth IRA, and we'll go to the SEP IRA and the simple IRA. And I'm going to give you all the info you need on how these IRAs work, the benefits, and when you got to make contributions by. So let's start with the traditional IRA. But what is the overall IRA market? Well, there's about 65 million IRAs, over $13 trillion in retirement accounts. Most Americans, their largest source of savings is an IRA, an individual retirement account. And we'll see almost anyone can set up an IRA. You need to have earned income. What's earned income? It means compensation for services, business income, 1099, W-2, selling a widget. What is not considered earned income is Social Security, disability, capital gains, interest, dividends, royalties, rental income, right? If it's just passive income that's not subject to either self-employment tax or Social Security tax, it is not deemed earned income, and therefore it is not eligible to be contributed to an IRA. So I have a lot of clients that call me and say, hey, Adam, this year I had a great year. I sold my business for $50 million. Did you take a salary? No. Well, you're not going to be able to make an IRA contribution, but you can piggyback off a spouse. If your spouse earns income, and we'll go through the income limitations in a moment, for a traditional IRA, you can technically piggyback off a spouse. Okay, so even if you have no earned income, but you have a former employer 401k funds, or you're leaving your job with a 401k or 403b or 457b, or you have an IRA at another institution, you can still set up a self-directed IRA. But in order to make a contribution to an IRA, you need to have earned income. Okay, so in 2024, you can put away $7,000 or $8,000 in an IRA, but for 2023, again, this video is focusing on making contributions for 2023. Yes, I know we're in 24 right now, but the good news is you can do IRA contributions up until April 15th for the 2023 taxable year. You can do them all the way up until April 15th, 2024. So you still have time. But once April 15th stops and April 16th starts, no more IRA contributions for or traditional and Roth for 23. Okay, the year kind of closes. Even if you file an extension for your 1040, you still cannot make an IRA or Roth IRA contribution for the 23 taxable year past April 15, 2024. It's just a rule. Okay, a lot of people get confused and they're like, oh, I'm filing an extension for my 1040, hence I should be able to make IRA contributions all the way up until October 15, 24 for the 23 taxable year. But unfortunately, you can't. Okay, so remember that. You still have time. It's April 10th today. We got 5 days. You have until midnight on the 15th. Whether you put the check in the mail, you wire the money, just make sure you do it. We know IRAs, traditional IRAs are pre-tax. You get a tax deduction. You can go all the way up to $6,500, $7,500 if you're over 50. But let's talk about who can make IRA contributions. So it comes down to, number one, you have to have earned income. And number two, whether you have access to a 401k at work or not. Why? The IRS is super fixated on deductions, and they don't want Americans to generate too much, too great of deductions. Why? It reduces taxable income, and by reducing taxable income, that means the government has less money to spend, and we know the government loves spending money. More than my kids like playing video games and going on TikTok, the government loves spending money. So they want to try to limit deductions. So this is how the rules work. If you don't have access to a 401k at work, even if you make $1 billion, you can still do $6,500 or $7,500 in an IRA for 2023, so long as you make that contribution before April 15th. If you are single and you're covered by a retirement workplace plan, like a 401k, a 403b, or 457, if you make more than $83,000 in 23, you cannot do a IRA contribution pre-tax, right? Which is stupid, right? But again, the IRS is so focused on limiting deductions. So they basically say, hey, if you make 95 or 100 or 84K, you're phased out. And because you have access to a 401k at work, even though necessarily you may not contribute or not put a lot in that 401k, we don't want you to supercharge deduction. So we're not going to let you save in an IRA, which again, I think is short-sighted, because you want to teach people good habits and encourage people to save, because we all know what Social Security is. It's about $1,700 a month. It starts, anywhere from 60 to 65. And that's money, but it's not enough. So the IRA solution is a great way to supplement Social Security. But it's important that people get good habits. So if you are married, okay, and the spouse, so let's say you're married and you're making the IRA contribution, okay, not your spouse, you, and you make more than $136,000 and you have access to a 401k at work, you cannot do a pre-tax IRA contribution. Again, it's all about limiting deductions. However, if you're married and the IRA contributor who is not covered by a workplace plan is married to someone who is covered. So I want to make an IRA contribution. Okay. I don't have a 401k at work, but my spouse does. I got a bigger phase out, and that's $228,000 in 2023. So if I made 160 and I satisfy the fact that I'm not covered by a retirement plan at work, but my wife is, I can still do a pre-tax IRA. But if I'm making an IRA contribution and I'm covered by a 401k at work, even if I don't put money in, I can't make more than $136K to get the pre-tax IRA contribution. So it's all about, again, limiting deductions. Okay, now let's move to the Roth. So that's the traditional IRA. The most common type of IRA, it's a pre-tax IRA. You pull money out, 59.5, you pay tax. If you pull it out prior to 59.5, tax and a 10% penalty. Once you hit the age of 73, required minimum distributions, RMDs, about 3% of your value. Contributions for 23 are due April 15, 2024, subject to those income limitations I just mentioned. And in addition, you need to have earned income. Roth IRA, I'm a big Rother. It's an after-tax account, no tax deduction, but so long as you're 59.5, the Roth's been open at least 5 years, once you pull the money out of the Roth IRA, all Roth IRA distributions are tax-free. I wrote a book on the Roth called In God We Trust and Roth We Prosper. I totally believe in that. So just like a pre-tax IRA, you can go for 23, $6,500 if you're under 50, $7,500 if you're over 50. Again, just like a pre-tax IRA, April 15, 2024 for the 23 taxable year. Still have a couple days left if you're watching the video live. The check's got to be in the mail by midnight, April 15th, or wire the money that day. So you can still make contributions with IRA Financial. Even if you don't have an account, we will fast track your account so that you'll be able to make that contribution before April 15th. Do not worry. And again, there's no extensions, right, for pre-tax IRA. Even if your 1040 is on extension, you cannot make a Roth IRA contribution after April 15, 2024. So who can make Roth IRA contributions? Well, quasi-income limitations. I'm going to say quasi and in quotations because I'm going to get to the backdoor Roth IRA, which is a circumvention of the income limitation rules, which don't apply to pre-tax IRAs. The pre-tax IRA income limitation rules I mentioned previously, there's no workarounds. You're either in or you're out. Okay, it's pretty black and white. For Roth IRA, there's a clear backdoor. Okay, so if you're married, filed jointly, and you guys earn more than $228K in 2023, you cannot, and I'm going to underline cannot, or maybe I should italicize cannot, make a Roth IRA contribution. And if you're single, make more than $153K in 23, no Roth IRA contribution. Again, italicize, underline. Why? Because the backdoor Roth IRA option. Basically, since 2010, the IRS got rid of income limitations on conversions. Prior to 2010, if you made more than $100,000, you were not able to do a Roth IRA conversion. Okay, but what happened? Financial crisis, government needed money, and a great way to premature accelerate tax payments is to encourage people to do Roth conversions. So they basically opened the door to Roth conversions for any type of taxpayer. And on top of that, they said, hey, if you do a Roth conversion at that point, we'll give you 2 years to pay the tax, which is great. That ended pre 2010, 2011, but the backdoor Roth continued to survive, meaning they did not reimpose an income limitation on conversions. Why? Because conversions make money to the government. So if you look at the Biden 2025 budget, which I did a whole I did a podcast. Adam talks on it. And there's income limitations for Roth conversions, I think at around 450K. And my point is that's never going to pass because the government needs money. And conversions are a great way to get taxpayer to premature pay tax. So why would they limit the conversions to folks that make less than 450? You would think that probably the conversion amount would be less for folks that have less in income. They probably have less in retirement accounts. Not super scientifically, but it's at least within the ballpark of reasoning that would be the case. So why would the government limit it? They won't. It's just Biden kind of just appeasing his progressive left wing, throwing in a bunch of stuff in the budget that will never pass. But that's where we're at. So the backdoor Roth IRA is a great way. If you make $100 million, $10 million, $300K, $500K, $700K, you can still do a Roth IRA. How does it work? You make an after-tax IRA contribution. So you open a traditional IRA, you put the money in, $6,500 or $7,500 if you're over 50, before April 15th, 2024 for the 23 year. And then you immediately convert it to Roth the next minute, the next day. And since you're going after tax to Roth, it's a zero conversion tax. Now, IRA Financial will still 1099-R and show a zero tax conversion. We'll handle that for you. Don't worry. Thing to keep in mind is there's something called the pro rata tax rule. Basically says if you have other pre-tax IRAs out there, you have to keep them in mind and calculate their value when determining how much of the backdoor would be tax-free. So I've used this example before. You have a $5,000 pre-tax IRA out there. You want to do another backdoor Roth IRA of $5,000. So basically 5 and 5 is 10 and 5 divided by 10 is 50%. Hence 50% of the $5,000 that you're going to backdoor today, $2,500 of that would be tax-free and $2,500 would be taxable. Okay. So you just got to keep that in mind. If you don't have any other pre-tax IRAs out there, then you can go backdoor all day long and just convert as many times as you want each year. And since you don't have any other pre-tax IRAs out there, there's nothing to worry about. Let's move on to the SEP IRA. The SEP and simple IRAs are going to be short. So this video will be done probably in the next 5 or 10 minutes. So just give me a couple more minutes and I'm going to teach you everything you need to know on these two plans. The SEP IRA is a pure profit sharing plan. It's 20% of your Schedule C, if you're a single member LLC or a sole proprietor, up to $66K in 2023. If you are a W-2 or you get a guaranteed payment from a partnership, it's 25% of your W-2 or 25% of the guaranteed payment, up to $66K. So if you have a sole proprietor and you make $100K, the max you can do is $20K. If you earn $100K W-2, the most you can do is $25K. Okay. Only businesses can set up SEP IRAs. You could be a sole proprietor, C Corp, S Corp, LLC. You just need to have a business. $66K. The difference in the income, we're going to get to the deadlines in a minute. It's different than a traditional IRA or Roth because this is a business profit sharing plan. An IRA and a Roth IRA are individual retirement accounts set up by individuals, not businesses. Starting 23, a SEP IRA could be pre-tax or Roth. Obviously, it's pre-tax. The company gets a deduction. The participant, the SEP IRA participant, does not recognize income. They'll pay the tax when they pull the money out after 59.5 or prior, which will also include a 10% early distribution penalty. Starting 23, thanks to the Secure Act 2.0, you can now do Roth SEP contributions. The company will still get a tax deduction, but here's the caveat. The participant has to take that amount of Roth employer contribution into income. The reason for that is if the IRS doesn't capture the income tax today, once you're 59.5, the Roth's been open 5 years, you can pull those funds out tax-free. So if they don't capture the tax now on the grant of that profit sharing contribution, they're going to lose the ability to tax it. So that's why those rules have to apply. So in interest of a SEP IRA, unlike a traditional line of Roth IRA, you could set up a SEP IRA for 23 anytime before the business files its tax return. Okay, so if you're a single member LLC or a sole proprietor, April 15th or October 15th with extension. So that means, let's say you're going to extension for the 23 taxable year, you can set up a SEP IRA October 14th, 2024. So you still have a lot of time left. If you're filing your tax return April 15th, no extension, sole proprietor or single member LLC, you have a couple days to do it if you're watching this video live. But depending on when you're watching this video, keep these dates in mind. If you're an S Corp or partnership, you have until March 15th or September 15th if you get an extension in 24 for the 23 taxable year. So you can still set up a SEP IRA, just to be clear, in 2024 for the 23 taxable year, so long as you set up the SEP, and you have a business, of course, before your S Corp files its return, including extension. If you have a C Corp, it's April 15th or October 15th. So just keep these in mind. April 15th, October 15th for C Corps, sole proprietors, and single member LLCs. S Corps and partnerships, 1065s. March 15th, September 15th for the 2023 taxable year. Okay. The simple IRA is also a business plan. It's kind of a poor man's 401k. Why? Because you can put in only $15,500 plus a $3,500 catch up if you're over 50. In 2023, a solo K will get you $22,500 or $30,000 if you're over 50 with the catch up. So it's a lot less. By the way, I should have said this up front. I'll say this at the end. I'm doing if you're watching this live, there is going to be a solo 401k contribution deadline video tomorrow, April 11th, 2024. If you are watching this taped on YouTube, then just check out our feed and you can click. And if you are self-employed or have a small business and have a solo K or don't have a solo K, there is still time to set up a solo K in 2024 for the 23 taxable year. It kind of mirrors the SEP IRA rules. The solo K mirrors it. There are just some caveats in terms of when the employee deferrals and the employer contributions have to be made. So just check out that video on solo Ks. It's also going to be about 30 minutes, and it's going to give you all the key information you need to make the right choice when making solo 401k plan contributions. Okay, so as I mentioned, it's a poor man's 401k. The key is this. A simple IRA must be set up January 1 to October 1. So unfortunately, in 2024, it's too late to set up a simple IRA for 23. Okay, you can't do it because we're past October 1st, 2023. So you can set up a simple IRA for 24 now, because we're between January and October, but you cannot do it for the 23 year. So, there's not much more to say on the simple. It could be pre-tax or Roth. Contributions, again, have to be made 30 days from the end of the year. So if you have a simple IRA in 23, you set it up, you would have to have made the contributions before January 30th, 24 for the 23 taxable year. But if you've not set up a simple IRA yet for 23, the time has lapsed and it's too late. So that's kind of it on the simple. As I mentioned in the outset of this video, every year matters. You want to take advantage of the power of tax deferral, compounding returns, the rule of 72. You want to maintain good habits. Small contributions matter. Every year matters. Trust the process and just kind of let the money work for you. That's the beauty of the IRA. And I'll say it again. I say it in almost every video I do. The U.S. retirement system is rigged in our favor. It's the only system that literally is guaranteed to work. It's not a zero-sum game. We all could be tax-free millionaires at retirement. All of us, every single one of us. We just need to do three things. That's it. Make IRA contributions, start every year, start as early as you can. Try to do them every year. If you can't max out, that's okay. And then 3, be patient, trust the process. Okay, it's as simple as that. What I'll do actually is we got a couple minutes. So let me just do a couple things. I like to do this stuff, and whenever I do it, people get blown away. But these numbers will show you the power of saving. Okay, so I'm going to go through some examples. I don't think I have anything less. No, you guys know why you should choose IRA Financial. I don't have to go into that. I want to just kind of give you the benefit of understanding the power of compounding returns and deferral, and why even $1 a day matters. Okay, so let's say we'll start at a young age. Let's say you're 21 and you do $500 a year, okay, until 72 years old, and assuming a 9% rate of return. Okay, we'll play around with that. So you're 21 years old and you just put in $500 a year from 21 to 72. Irrespective of the fact that you're going to have more income and eventually you'll make more money, let's just say you put $500 a year in every year from 21 to 72. At a 9% rate of return, you're going to have $444,720. If you did it in a taxable account, subject to a 25% tax rate, you'd only have $199,000. So you double your money. That's just on $500. Now, let's say you are 24 years old and you do $1,800 a year. Okay, 72, 9% rate of return. You would have $1.23 million at 72 just for $1,800 a year, which is like whatever, $130 a month. Doable, right? If you did it in a taxable account with a 25% tax rate, you'd have just $586,000. Okay, so you more than double your money based off deferral, compounded returns, and the IRA system. Okay, let's say it's going to go up, so it's not too late. You're 30 years old, and you're going to put away $3,500 a year, assuming an 8% rate of return, a 9% rate of return. Okay, you're going to have, let's see how much you're going to have. You're going to have, what did I say? 20. Let's just say 30 years old. $3,500, 30 years old to 72, 9% rate of return, $1.4 million. If you did in a taxable account, you'd have $753,000. Okay. Let's say you are 33 years old and you're going to do $4,500 a year, assuming a 9% rate of return. I say 9% because right now you can get 5.5% for sleeping on your couch. So you should be able to get over a 30 to 40 year period. If you look at the S&P 500 over the last 100 years, it's averaged almost 11% on average. Okay, some years are up, some are down, but if you average it out, it's about 11%. So if you look at the next 40 years, I think it's safe to say you should be able to average 9%. And that would get you $1.39 million if you put away $4,500 every year from 33 to 72. Okay, but imagine if you put away $4,500 from 23 to 72, you'd have $3.36 million. So this is my point exactly. The younger you start, continue being consistent. That's why I keep the same numbers throughout the process. Now, I know things happen. Some years you put in less, some more, but if you can stay consistently at a number you can afford and just let it flow, right? Every year, just be like, I'm filing my taxes, I make an IRA or Roth IRA contribution, and I let it ride. I don't even worry about it. I look at my IRA every couple of years. I have some lockup investments. My IRA is diversified. My Roth IRA, I should say. I own cryptos, gold, real estate. I have some private equity deals, some hard money loan deals, and I have equities, stocks. So I look at my cryptos and stocks, probably every couple of weeks. I know the stocks I own and Bitcoin, so I kind of know the value. I don't really have to look at it, but on my more long-term investments, I look at that usually every quarter. And in my head, I'm like, I want to kind of reevaluate every couple of years, but I know I'm not going to touch this stuff till I'm in my 70s. And I'm going to use this as a supplement to Social Security, hopefully help my kids buy a home, maybe buy a vacation home, whatever, right? This is going to be some spending money for me and my family when we're older. And to me, it just lets me sleep well at night. And that's why I'm doing this video, because it's so important to just be patient. And that's the hardest thing to teach young people, especially today, where everything is like instant gratification, whether it's social media, whether it's just, one day shipping or DoorDash or Uber Eats. Like you want it now. But the retirement system is the opposite. Good things come to those who wait. So if you are always urgent and need to get things instantly, you're actually not going to be able to maximize the retirement system to your advantage. If you're patient and you just remember it's based off math, right? If you don't trust me, Albert Einstein said compounded returns is the eighth wonder of the world. It's not me. It's just a rule 72, right? 9% rate of return every 8 years, your money doubles. So just think about that. Okay, I'm just going to go for it 9%. I'm going to buy equities, real estate, cryptos, gold, whatever you want. It's your money. And I'm just going to keep going. Every 8 years, my money will double. So if I have 50K, in 8 years, I should have 100K. And after 8 years, 200K, then 400K, then 800K, then 1.6 million, right, when I'm in my 70s. So that's why I said the retirement system is not a zero-sum game. It can make us all tax-free millionaires. We just got to do three things. Start as early as you can. Be consistent in making IRA contributions, develop good habits, and trust the process. Be patient, and the math will take care of itself. So thank you. I hope you guys enjoy the video. Remember, IRA and Roth IRA for 2023, you have until April 15, 2024, no extensions. Just remember the income limitations in the backdoor Roth IRA option. For SEP IRA, you can set up the SEP IRA for 23 up until your business files its return, whether it's a sole proprietor, single member LLC, that's April 15th. Or October 15th, C Corp, April 15th, October 15th, S Corp, or a partnership March 15th, which passed, but if you file an extension, September 15th. Simple IRA, the time has lapsed for 23, but there's still an opportunity for 24. And last thing I'll say is check out tomorrow's video if you're watching this live on solo 401k, contribution deadline rules, super important. There's some really cool things you can do with the mega backdoor and some other tricks I'll talk about. And if you're watching this taped, definitely check out the solo 401k contribution deadline, because even though you're sitting in 2024, there are still lots of time left to set up in 23. And guess what? You can actually set up a plan for free because there is a $500 auto enroll credit each year, where simply by checking a box and being subject to auto enrollment, you'll get a $500 credit from the IRS, which will cover the cost of setting up the 401k plan and administering it each year. So I got a couple questions. Let me dive into those real quick. Chris, sorry, this is a little off topic. If I have to pay UBIT tax for my self-directed checkbook, can I write a check from the LLC checking account? Yeah, you can do that. Remember, the 990T will help you file it if you're a client. The IRA needs to file that. You'll get an EIN for the IRA. Technically, it's an IRA tax, but yeah, you can deposit it. You can send the money from the LLC. The IRS doesn't care where the money comes from. They just need the money. Another one, Chris, if I roll my self-directed IRA into a solo K and down the road the business closes, what will I need to do? So when you set up a solo K, it's supposed to be permanent. So you can have a number of years where the business kind of is on pause mode. But if, Chris, you're really terminating the business, retiring, just moving on, no problem. You just roll the money or the assets back into a self-directed IRA tax rate. So you can always in-kind the assets or the cash back to the IRA. In order to get money out of a 401k, you need what's called a triggering event. And a triggering event is you leave your job. Okay. Solo K, that's hard to do. You close the business, bank, or you're 59 and a half. So Chris, don't worry, we got you. You will have flexibility to get the money in, the assets in, and the assets out of the plan tax free. That's it for today's video. Hope you guys enjoyed it. I appreciate you hanging out with me today. Remember, tomorrow will be the solo 401k contribution rule for 2023, how to take advantage of the deadline rules, some tricks of the trade. If you are watching this tape delay, thank you. And definitely check out the feed for that video and other videos. If you have comments, questions, leave them, please. I love hearing from all of you. I get some amazing feedback, some great questions, and it's a great way for me to learn from all of you. So thank you again. Have a great day, and see everyone again tomorrow or soon, I hope. Thanks.